In 2001, Fortune magazine named Enron America's most innovative company for the 6th year in a row. Its stock had soared to $90 a share, making it a Wall Street darling worth over $60 billion. But this success was a carefully crafted illusion, built on fraud. So how did a company that seemed so successful turn out to be a mirage? The answer lies in accounting tricks that turned future promises into present profits. Enron used something called mark-to-market accounting, allowing it to book revenue from long-term contracts immediately, even if the money might never come. But the deception went deeper. Enron created hundreds of off-the-books partnerships, called special-purpose entities, to hide over $1 billion in debt. These shell companies, with names like Chuco and LJM, were used to make the balance sheet look healthy. It was a house of cards, and it was only a matter of time before it collapsed. So how did Enron become America's most admired company? It wasn't through innovation in energy markets. It was through a carefully crafted illusion of success, built on financial engineering and hype. The company's reputation was a product of deception, not genuine achievement. From 1996 to 2001, Fortune named Enron America's most innovative company, 6 years running. Its stock soared to $90.75 in August 2000, giving it a market cap of over $60 billion, but the numbers were a mirage, a carefully constructed illusion that masked the company's true financial health. The secret behind the illusion: mark-to-market accounting allowed Enron to book projected profits from long-term contracts as immediate revenue, turning future hopes into today's earnings. This accounting trick was the cornerstone of Enron's deceptive financial reporting. Enron's reported profits were not based on cash received, but on estimated future gains from contracts. This method let the company recognize revenue immediately, creating an illusion of profitability that masked underlying losses. Under this accounting rule, Enron could take a 20-year gas contract and record its entire estimated future value as profit on day one. The gas hadn't flowed yet, but the revenue was already booked. This meant Enron's reported earnings were not based on real cash, but on optimistic assumptions. When those assumptions proved wrong, the profits evaporated. But by then, the illusion had already fooled Wall Street. So how exactly did these special-purpose entities work? The mechanics were simple. Enron would create a separate company, transfer its debt to it, and then claim the debt didn't exist. But here's the catch. These entities were controlled by Enron executives, not independent investors. This lack of independence was the key to the fraud. Take Chuco, for example. Named after a character from Star Wars, it was created in 1997 to hide $600 million in debt from Enron's balance sheet. The entity was run by Enron's CFO, Andrew Fastow, who personally profited from the arrangement. Then there was LJM, another Fastow creation. The name stood for his wife and children's initials. LJM allowed Enron to sell assets at inflated prices to itself, booking fake profits. Fastow made $30 million from these deals. These SPEs were not secret. They were approved by Enron's board and audited by Arthur Andersen. But the auditors looked the other way, accepting Enron's claim that the entities were independent. In reality, they were puppets. The scale of the deception was staggering. By 2001, Enron had created over 3,000 SPEs. These entities hid more than $1 billion in debt and inflated earnings by hundreds of millions. The chart shows the explosive growth of these off-balance sheet vehicles, which were the engine of Enron's fraud. But this house of cards couldn't stand forever. The SPEs required constant new deals to keep the illusion alive. When the market turned, the dominoes began to fall, and the first one was about to topple. So why did nobody stop it? In August 2001, Enron Vice President Sherron Watkins sent an anonymous memo to founder Ken Lay. She wrote, "I am incredibly nervous that we will implode in a wave of accounting scandals." She warned that the company could unravel if its off-the-books partnerships were ever exposed. But Lay did nothing. He convened a meeting with Enron's law firm, Vinson & Elkind, which concluded the allegations were not serious. The warning was buried. Watkins later testified that she felt the company was in denial. The house of cards would stand a little longer. So why did nobody stop it? By October 2001, the illusion began to crack. Enron reported a staggering $618 million third-quarter loss and a $2 billion reduction in shareholder equity. The numbers that had once dazzled Wall Street were now revealing their true nature, a company built on debt and deception. The stock market reacted swiftly. Enron's shares plummeted from $90.75 to under $1 by November 2001. Investors who had believed in the mirage saw over $60 billion in market value vanish in a matter of weeks. Desperately, Enron tried to find a savior. A merger with rival Dinergy was announced, but it fell apart when credit rating agencies downgraded Enron's debt to junk status. The entire structure was collapsing faster than anyone could patch it. On December 2, 2001, Enron filed for Chapter 11 bankruptcy. With $63.4 billion in assets, it was the largest bankruptcy in U.S. history at the time. Thousands of employees lost their jobs and life savings. The illusion was finally irrevocably shattered. So the collapse of Enron did not end with the company. Its auditor, Arthur Andersen, was convicted of obstruction of justice in 2002 for shredding documents. The verdict effectively destroyed one of the Big Five accounting firms, costing 28,000 employees their jobs. But the reckoning went further. CEO Jeff Skilling was sentenced to 24 years in prison for fraud and conspiracy. CFO Andrew Fastow pleaded guilty and served 6 years. Founder Ken Lay was convicted but died of a heart attack before sentencing. The architects of the illusion faced justice. So what drove such audacious fraud? At its core, Enron fostered a culture that rewarded risk-taking at any cost. Employees were ranked on a forced curve, and the bottom 15% were fired each year. This pressure cooker environment pushed people to do whatever it took to meet targets. On the trading floor, Enron's culture was especially toxic. Traders bragged about manipulating California's energy market during the 2000-2001 crisis. They created fake congestion to drive up prices, earning the nickname the world's largest hedge fund. But not everyone went along. Sherron Watkins, a vice president, discovered the accounting irregularities and bravely wrote to Ken Lay. She warned that Enron could implode in a wave of accounting scandals. Her memo was a last chance to stop the disaster, yet Enron's board of directors, including prominent figures, approved the SPEs and waived conflict of interest rules. They were supposed to oversee management, but instead they rubber-stamped Fastow's schemes. The board's negligence was a critical enabler of the fraud. Wall Street analysts also share blame. They continue to rate Enron a buy even as red flags emerged. Why? Because investment banks earned huge fees from Enron's deals. The conflict of interest was glaring, but few analysts dared to speak out. The media too was complicit. Fortune magazine named Enron America's most innovative company 6 years running without questioning the numbers. The press celebrated Enron's executives as geniuses, amplifying the illusion and discouraging scrutiny. But the real tragedy was the human cost. Enron employees lost not only their jobs, but also their retirement savings, which were heavily invested in company stock. Many had been encouraged to buy more shares just before the collapse. Their lives were shattered. So Enron's legacy is not just a cautionary tale. It led to the Sarbanes-Oxley Act, which strengthened corporate accountability. But the lessons are still relevant today. The same greed and lack of oversight can resurface, as seen in later scandals like the 2008 financial crisis. But these entities weren't just passive shells. They actively traded with Enron, creating a web of transactions that obscured the company's true financial state. Each deal generated fake profits, but also new liabilities that required even more SPEs to hide. The ripple effects extended beyond Enron. Pension funds that had invested heavily sued for losses. The scandal eroded trust in corporate America, leading to a wave of regulatory reforms that reshaped Wall Street's landscape. Yet despite the reforms, similar frauds have recurred. The 2008 crisis exposed new accounting tricks, and recent scandals like Wirecard show that the temptation to fake success remains. The Enron playbook is still in use. And so the illusion that had dazzled the world was finally exposed. In response, Congress passed the Sarbanes-Oxley Act of 2002, imposing stricter corporate governance and auditing rules. The scandal had fallen, but its legacy was a new foundation of accountability.